Okay, hello everybody. Welcome to Korean Atlanta Mentorship. And in this video, I'm going to talk about how the way banks make money is kind of similar to Big Pharma. I don't know if you ever heard this joke, and I heard this joke a long time ago from Bill Maher. But there's two types of bad prospects for Big Pharma. The first prospect is someone who's dead, right? Because if they're dead, you can't give them medication or sell them medication, right? Now, the second type of bad prospect for Big Pharma is someone who's healthy and alive, right? Because you can't sell medication. So what they want is the type of prospect that would be like their best type of customer is someone who's constantly sick but still alive. So they kind of want you in the middle. They don't want you in the extreme end of things, right? And it's the same thing with banks. So what's the concept? What is a bad prospect for a bank, right? And this kind of relates to credit scores too, and I'm going to kind of get into that as well. So number one, a prospect who's really bad for the bank is somebody with no income, right? That's kind of like the big pharma equivalent of being dead, no income. Number two, lots of income and pays off debt quickly, right? And the reason why this is bad for the bank is because if they loan you money, whether it's credit cards or loans, they're not going to make any interest, and that's pretty much their profit, right? So their business model is kind of like a subscription model, similar to Big Pharma or Netflix. When they give you loan you a 30-year mortgage, that's a long time. That's kind of like a subscription for your home, right? And then the moment that you don't pay it, that's when they take the home away from you. And so as long as you pay that subscription for 30 years, you're good. See, it's kind of like Big Pharma. So what's the best prospect for a bank, right? I would say the best prospect, let's spell this out, is someone with lots of income and doesn't pay off debt quickly, right? So it's like kind of like this here, where if you're alive, but you're not too healthy. And it's kind of like the alive part is like lots of income, but the not too healthy part is you don't pay off your debt quickly, right? And and this kind of relates to credit scores. So let me just kind of show you how this is related to credit scores. Now, a lot of people relate credit scores, the way that they think of credit scores is kind of like SAT score, right? The higher the better. Like if you get a high credit score, that's like the best thing ever. And if you get actually educated about credit, you should have a more mature understanding that a higher credit score isn't really what you want, right? When it comes to credit, you just want the ability to borrow money. In addition, who is the high credit score for? Is it for you or is it the bank, right? Because I don't know if you know this, but banks actually pay money to report your payments to a credit bureau. Why would somebody be willing to go through all that effort, not only to keep track of your payments, but tell the credit bureaus that you're paying either on time or not on time? Because that's incredibly valuable data that is to be shared among various lenders, right? And so the lenders have an interest in making sure that they know what type of a risk you are, right? Risk. So the credit score doesn't measure, it's not like a SAT score. And if you know anything about Boolean logic or computer logic, this means does not equal. But is not an SAT score, right? It's not for you. It doesn't really, it kind of tells you your future, but it's more about a predictability and risk score for the banks of if you're a best prospect for their products, which is loans and credit cards, right? Because a person who pays off their debts quickly is a bad prospect for the bank. So let's say you have lots of income and you pay off your debt quickly, the bank is going to make that much money. And so thus a person who, let's say, gets maybe a 30-year mortgage. So let's say you get it at 6% interest, right? 6% APR. After 30 years, that person is going to pay 115% interest. Okay. Now let's say you pay this off in 1 year, 1 year payoff. There is no way, if you pay it off in 1 year, you're only paying 6%, right? Probably. You're not going to pay anywhere near 115%. So if the bank projected that they were going to make 115% off of that 30-year loan, but you only gave them 6%, then that's a big risk to them because you fit in the bad prospect category, which is number 2, rather than the best prospect category. The best prospect has lots of income and doesn't pay off debt quickly. So you ever notice that if you have a lot of income and you have low credit limits and then you start swiping that credit card and paying it off in full every single month, sometimes the banks, they automatically increase your credit because eventually, even though maybe, obviously it's better to be at number 2, like have lots of income, pay off debt quickly than number 1. But what their goal is, their hope is that even though you're a bad prospect right now, eventually if they raise your credit limit enough, you're going to turn into the best prospect, which is lots of income and doesn't pay off debt quickly, which is why they raised the credit limit, right? Because you might have like a $5,000 credit limit and then they might have bumped it out 10 or 15 automatically without even telling you because they have the data, they have the algorithms, they look at it and like, oh, this guy pays off debt quickly, he makes over $100,000 a year. We want to make sure he doesn't pay off that debt quickly, so let's let him borrow more, right? So number 1 is the worst. They definitely want nothing to do because if they lend you $1,000 and you're not able to pay it because you don't make any money, they don't want to lend you money at all. Number 2 is better, right? Because they'll lend you money, they'll pay it off, but they're not going to make any money off of you. So what they hope to do is, if you're at this point, get to the point here where you have lots of income and you don't pay the debt off quickly, because then if you have debt, carry debt from month to month to month, then then they're raking in the money, right? And just be aware that this credit score is not for you, right? It's for the bank, right? So the higher doesn't necessarily mean better, because let's say you have an 800 plus credit score. For the bank, it's telling you you're the best prospect because you have lots, maybe you have, and this is a gross simplification, but you have money and you just make payments over time, you don't pay off the debt quickly, right? Because if you pay off the debt quickly, that's more risk for the bank. So as I said for here, and here's the other thing too, I want you to think as if you were the lender, right? And you're evaluating prospects using their credit scores. Like someone wants to take a loan or a credit card debt from you, and you have to create your own evaluation metrics of who's the best prospect to lend money to. Okay? Well, this person has lots of income and borrows money, but I notice that every time this person gets a loan, maybe the loan term was supposed to be 5 to 10 years, pays it off in like 6 months. I don't want, this person isn't going to get an A plus as a person to lend to in my books, because I was going to make a lot of interest if we just made the minimum monthly payment for 5 to 10 months, but you paid it off too quickly. So I'm going to give you that person a C, right? So kind of think of it that way. Again, it's like Big Pharma, where you can't have dead prospects because you can't give a medication. They can't be too dead. Same thing with here. You can't deal with no income people, because if you lend money to no income people, even if they quote have good credit, you're going to deny them because they're not going to pay you back. You're going to lend them $5,000 and then, but it's almost like throwing money away or burning money. You can't have healthy and alive, because if they're healthy and alive, how are you going to sell them medication? How are you going to sell them the monthly pills and, doctor's visits and all that? Can't do that, right? Same thing with the bank. It's like, being healthy alive is like having lots of income and paying off your debt quickly, right? So you want to get to the ideal prospect, kind of like Big Pharma, where you're alive, but you're kind of not feeling too healthy, right? And that's kind of the same thing with the best prospect of it. You got lots of income, just don't pay it off to debt quickly, and that's kind of like a hole in your bucket, right? That's like the water, the life force out of your your spirit slowly dissipating away, which is what debt does if you don't pay it off quickly. Now, debt's a tool, right? But again, think about it, and the best way to think about it is pretend like you are the lender. And if you pretend like you're the lender, you can understand much easier what the purpose of credit scores are, how mortgages work, right? How loans and credit cards and all that works, and think of a way like, how do I maximize the return on this? And who's the best people to lend to? Because it's certainly not people who make a lot of money and pay off their debts quickly. And I think a lot of people have this myth inside their head that that's what banks want, because they want, people who are good with money and know how to manage it. That's quite not true. What they want is people with a lot of money but are terrible at managing it, right? That's really my ideal prospect if I were to lend money to people who just make minimum monthly payments over time and then wonder where did it all go? So this is how you got to think of it. And so this is just a commentary of understanding like where the banks want you to be, right? They want you to engage in something called segregation of income, which we kind of go over other videos. But have your money split into all the different places in Wazoo, or I don't even know. It's late. I'm getting sleepy, but split up the Wazoo, and then make you feel like you're living paycheck to paycheck, because that's how they're going to make their interest. No bank wants you to make you uh, pay off your loans early. And some people think, well, if I do that, that makes me a good person. But having a good credit score has absolutely nothing to do with being a good person, but it's more about how much risk the bank takes when they loan to you. So when they evaluate you with a high credit score, that means you're a very, very low risk and you're, quote, a best prospect. All right, so I hope you learned something here today. This is Korean Atlanta Mentorship. If you're interested in joining our group, go ahead and click the Google form link below. We'll get a one-on-one Zoom chat. If you have any questions, comments, leave them below in the comment box, and we will speak next time. Have a great night, everybody.